The World Bank and the International Monetary Fund have ensured that African countries are forced to struggle in debt traps. It becomes difficult for African countries to survive without debt because they were pillaged and continue to be pillaged now. That is the IMF's, headed by the West wish. The more debt African nations take on, the more pressure there will be on them to abide by Western demands. Furthermore, it guarantees that African nations will perpetually struggle in debt traps and never prosper. Lazarus Chakwera, the president of Malawi, has insisted that the IMF forgive the country's debts. Its exorbitant interest rates will prevent it from being able to pay the loans. Also, if all payments are included, the fact that they have already been paid. He saw how the Western countries were manipulating the IMF, so knowing them, he stood at the UN General Assembly and issued an ultimatum. He claimed that Malawi will reach a stage where the West would not be pleased unless the loans were eliminated. What does he intend to accomplish, and what does he mean by that? Let's investigate and learn the complete tale. Lazarus Chakwera, the president of Malawi, has urged wealthy countries and international financial organizations to give serious thought to wiping out the debts of faltering economies. It's enough since these nations paid off their debts in spite of their struggles and the poverty that befell their citizens. It's equivalent to enabling the IMF's top financiers to profit from denying Africans of their fundamental needs, such as food, clean water, and a place to live. According to Chakwera, the heavy load that many least developed nations like Malawi have serves as a roadblock for them as they attempt to overcome the never-ending problem of debt repayment. This weight has impeded their capacity to catch up to more economically developed countries, as well as their potential to advance economically. These loans are making sure that underdeveloped countries never escape debt traps, not easing their situation. These countries take out fresh loans in order to pay back the previous ones, plunging them into an endless cycle of debt from which they will never escape. Citing the UN's 2030 goal to abolish poverty, he made his demand even stronger. But if debts owed by African countries are forced to be paid, this will not be feasible. If increasing the wealth of the affluent countries is a means to reduce poverty, then perhaps it is a good way. But since the reality is that the situation is the exact reverse, developed nations must determine that the debt owed to emerging nations must be canceled. Like the majority of least developed nations, Malawi is struggling with an unmanageable debt load, which is why President Chakwera vehemently said that we urgently need to take decisive action on the debt issue. We continue to implore on behalf of all LDCs, pay off the loan. In addition, Chakwera highlighted the lackluster progress the UN community has made in terms of economic growth in recent years, noting a number of obstacles as the ongoing COVID-19 pandemic, natural disasters, and the conflict in Ukraine. He maintained that these enormous obstacles serve as much more evidence of how urgent it is to reduce emerging nations' debt loads. President Chakwera made a similar plea for debt cancellation in his speech to the UN General Assembly last year, urging major economies to take China's lead and forgive a portion of the debts due by African nations. President Chakwera is still actively pursuing financial backing to help Malawi in its unwavering quest of economic progress through his interactions with leaders of foreign organizations. Currently, Malawi struggles with debt. Specifically, its obligations to the International Monetary Fund have created significant barriers to the nation's economic development. Malawi has accumulated a sizable amount of foreign debt throughout time, including loans from international organizations like the IMF. Because of the nation's enormous debt loads, a significant portion of its budget is allocated to debt servicing. Therefore, paying down this debt takes up a large amount of the government's yearly budget. As a result, money intended for important areas like infrastructure development, healthcare, education, and poverty alleviation is instead used to pay off debt. As a result, there is less financial room to meet urgent home demands. Reduced public spending on vital social services is the outcome of having to dedicate a significant portion of the budget to debt payment. Among them is healthcare, which necessitates financial outlays, particularly in light of the COVID-19 pandemic. Similar budget cuts have been made for programs aimed at reducing poverty and promoting education as a result of these financial difficulties. Significant shortcomings in Malawi's infrastructure include inadequate telecommunications, energy supply, and transportation networks. The government's ability to fund infrastructure development, which is essential for promoting economic growth and drawing in foreign investment, is hindered by the weight of debt. Debits, which are meant to alleviate economic crises, begin to put nations like Malawi in danger. Furthermore, the debt load keeps Malawi dependent on outside assistance. The country is reliant on donor help to fill the funding gap for essential programs and services because a sizable portion of the budget is allocated towards debt repayments. Growing amounts of debt increase the likelihood that a country may experience debt distress, or unmanageable debt. Or to put it another way, a country's economy will collapse if it tries to pay off its debt. This is the situation in Malawi, which is the reason the country's president has called for the cancellation of the debt. He made it clear that Malawi will unavoidably be unable to pay its obligations if they are not eliminated. He insisted that the IMF should be the one to cancel the loans rather than letting that happen, which would have made the IMF appear weak. Malawi must make sure it never applies to the IMF again for loans after they are terminated. You should be aware that policies like structural reforms and fiscal austerity measures are frequently attached to IMF loans. To put it plainly, the government turns all economic decision-making up to the IMF. Since an organization creates policies, putting these requirements into practice might be difficult without negatively affecting the welfare of the populace. As a result, the government has less flexibility to implement policies that support long-term development objectives. Furthermore, Malawi's attempts to pay back its loan to the International Monetary Fund may be hampered by the volatility of the US dollar. The reason for this is that the IMF is denominated in US dollars. Malawi therefore usually borrows money in US dollars from the IMF. When the value of the US dollar increases, Malawi must set aside more money in Malawian kwacha, its local currency, to buy the equivalent quantity of US dollars required to pay down its debt. The expense of repaying the debt in local currency is greatly increased by this exchange rate risk. In local currency terms, Malawi's debt effectively grows larger when the value of the US dollar rises. Malawi's finances are burdened more as a result of having to exchange more kwacha for every dollar due. Malawi's government now has to set aside a sizable amount of its budget to pay down its IMF debt. In order to pay off these debts, the government has to set aside a bigger portion of its budget when the value of the local currency declines in comparison to the US dollar. As a result, funding for important economic projects and public services may become scarce. In turn, Malawi may see greater rates of inflation as a result of a declining local currency. Imported products and services become more expensive when the value of the kwacha declines, causing inflation to rise. In turn, inflation may have a negative impact on the nation's overall fiscal health and economic stability. Furthermore, Malawian consumers' and enterprises' purchasing power is negatively impacted by a declining local currency. This may impede economic expansion and make it more difficult for the government to raise the funds required to pay down its debt. You should be aware that outside variables like the state of the world economy and US monetary policy have an impact on Malawi's capacity to manage its debt obligations. Variations in these outside variables have the potential to worsen the problems caused by swings in exchange rates. You can now see how loans from the IMF cause more harm than good. It should be evident that the president of Malawi is demanding something rather than asking for it. This is so because he isn't requesting a favor. You can comprehend it by being aware that due to the high interest rates on the loans, the total amount of debt payments made by a nation will exceed the amount owed to the IMF. To put it another way, Malawi has paid off its debt, but the high interest rate is causing it to remain outstanding for many years. For many years, African nations have been paying off their debts by consistently sending both main and interest payments. Their national budgets have frequently been heavily depleted by these payments. It is then that the International Monetary Fund's use of debt as a tool to exert control over African countries and impede their progress becomes evident. The reason for this is because African nations usually rely on loans and other forms of financial assistance from outside sources, such as the IMF, to support their endeavors towards economic development. These loans have long repayment periods and restrictive terms, which frequently trap African countries in an endless debt cycle, where paying off these debts takes up a large amount of their budgets. For more videos about Black history, culture, civilization, and identity, please remember to like, share, and subscribe to our channel. Now let's go on. Usually the IMF places policy requirements, also referred to as structural adjustment programs, on the loans it makes. The IMF essentially creates policies that guarantee debt becomes a significant component of that nation's economy under a respectable guise. That country would collapse if it stopped accepting IMF loans. Because of this, nations ultimately take on more and more IMF loans, which causes them to get further and further mired in debt. The requirements demand that borrowing nations carry out certain economic policies, which can involve trade liberalization, privatization of state-owned businesses, and austerity measures. Although the goal of these policies is to promote economic stability, they may also have unintended consequences on the social and economic fronts, such as lower public spending on essential services. Critics contend that the IMF's imposition of policy requirements may be seen as a limitation on the autonomy and sovereignty of African countries. These governments may be less able to pursue internal policies that support their long-term development goals if they are forced to implement these policies in order to obtain financial aid. The IMF's recommended policy changes and austerity measures may have significant negative effects on the economy. Human development metrics may suffer from public spending reductions, especially in the areas of health and education. Furthermore, societal instability and job losses are occasionally consequences of privatizing state-owned assets. Foreign investors may now possess the state-owned businesses that were formerly responsible for job creation. In this way, the West has acquired ownership of numerous businesses in African nations. First, it puts them in a situation where selling the state companies is their only choice. It may be difficult for African nations to achieve debt sustainability due to the weight of their enormous debt loads and debt servicing obligations. A never-ending cycle of debt can be created by continuously borrowing to pay off debt, which could jeopardize stability and economic advancement. You'll be shocked to learn how the IMF has used debt traps to immobilize Africa. A startling 21 low-income African countries were either experiencing or about to have a financial catastrophe in 2021. 58% of the countries that were assessed were included in this concerning condition. All of these countries had to shoulder the heavy weight of an incredible $644.9 billion in debt. African nations are expected to pay $68.9 billion in US in foreign debt service in 2023. This financial commitment is significant, especially considering the economic difficulties that many of these countries are currently facing. To put things in perspective, in 2021, the total GDP of African nations represented 24.0% of their external debt. This figure illustrates a concerning trend. Africa's debt load has increased to the greatest level in more than 10 years. 21 low-income African countries are now battling with bankruptcy or are headed into financial difficulty as a result. Since 2014, the rate at which Africa's debt has increased relative to its GDP has increased quickly and steadily. For the nations for which data is available, this percentage will stand at 24.0% by 2023, indicating a worrying trend. This begs the question of where these loans will ultimately take the African nations. It becomes evident that there has been a significant shift in the perception of African debt. Most of Africa's external debt is now owing to official creditors, mostly wealthy countries, and prestigious multilateral organizations like the IMF and World Bank. The fact that African countries are preparing for historically high debt service payments in the coming years only serves to complicate matters. Notably, even before the pandemic struck, more than 30 African nations were allocating a bigger percentage of their budgets to debt repayment than to basic healthcare requirements. This emphasizes how vital it is to have strong development programs and long-term debt management plans in order to overcome these complex financial obstacles. The average debt ratio in sub-Saharan Africa has more than doubled in only 10 years, rising from 30% of GDP at the end of 2013 to an unsettling 60% of GDP by the end of 2022. Also, there has been a noticeable increase in the cost of debt servicing. In addition, during the early 2010s, the region's interest payment to revenue ratio has more than doubled. It is currently about 4 times higher than the ratio found in developed economies. Unbelievably, the IMF estimated in 2022 that more than half of sub-Saharan Africa's low-income nations were either currently in debt trouble or were very likely to do so. There are now worries about an impending financial crisis in the area due to these concerning developments. African countries are therefore intensifying their attempts to strengthen their position inside the World Bank and the International Monetary Fund in order to prioritize the needs of developing nations who are facing one of the most difficult economic crises of our time. Difficulties to the economy since the financial crisis of 2008. In advocating, the president of Malawi is not by himself. Ghana's finance minister, Ken Ofori-Atta, emphasized the significance of international action to create a more inclusive global financial system at a speech in Washington, D.C. First and foremost, he said, Africa has to be given a major place in the international multilateral framework. Many sub-Saharan African countries are facing significant obstacles in 2023, such as a lack of capital, soaring governmental debt, and double-digit inflation. The rapid tightening of global monetary policy by wealthier countries in an attempt to slow down increasing inflation is the reason why developing countries are unable to get alternative funding sources. The problem has been made worse by the fact that the effective exchange rate of the US dollar has risen to its highest level in 20 years, making it more difficult to service debt denominated in dollars. Recent months have seen an increase in calls for reform of the Bretton Woods financial institutions, particularly the World Bank and IMF, as the growing debt crisis poses a threat to undo the socio-economic progress made over the previous 25 years. The World Bank and IMF are being urged to provide faster help and more generous aid packages than what is currently offered by African finance ministers and their teams. Concerns have also been raised about how the World Bank's growing focus on climate change would undermine initiatives to reduce poverty, possibly to the detriment of low- and middle-income countries. Ofori-Atta, Ghana's finance minister, expressed dissatisfaction with the World Bank and other multilateral organizations' failure to adequately address important problems. He argued that the current system is unable to promote shared prosperity and alleviate poverty at the necessary rate and size. Throughout the spring sessions, the topics that kept coming up were the necessity and scope of addressing Africa's problems. Recognize the difficult decisions that African governments have to make when balancing debt payments against investments in social and physical infrastructure, stated Abibi Selassie, the IMF's director for Africa. One salient feature of the current arrangement is the restricted power enjoyed by the nations most in need of assistance. This anxiety is shown in Ofori-Atta's request to be seated at the table. African governments are less likely to accept the current situation, in which wealthy countries that provide funding have significant influence over important decisions regarding the system's operation in an increasingly multipolar world, with the emergence of other financial partners like China, Turkey, and Gulf nations. It becomes evident why the president of Malawi has formally spoken out against the cancellation of African countries' debts at the UN General Assembly. This was previously stated informally because it was thought to be an unfeasible alternative. The only choice, though, is to cancel the debts when the impending dangers and the ways in which the IMF has siphoned off money from African nations are taken into consideration. Should all of Malawi's and other African nations' debts be forgiven by the IMF? Is it not the case that these debt traps are used by the West to prevent African nations from investing in their development? Tell us if Malawi ought to be the first nation in Africa to default on its debts, setting off a domino effect. Would you like to see more videos similar to this one? Click the bell icon next to it and subscribe to our channel if the answer is yes. We have made the decision to present videos on a topic that is rarely discussed: Black history, culture, and civilization, as well as examples of how amazing Black people have always been. I appreciate you viewing, and be sure to tune in for the next one.